give it a second longer. Oh, perfect. We are live. Excellent. Oh, and we got knocked offline, it looks like. This perfect. We
okay,
are
great.
Okay, we're back live. Ladies and gentlemen, thank you for tuning in and waiting for a bit there for us to get connected. We are live streaming from New York City. I am in the TradingView office at the moment. I am your host, Steph. And with me today is David Russell, the Global Head of Market Strategy at TradeStation. We're going to be going through all things markets, analyzing the charts, talking about the most important stories, and just generally, browsing all of the things that we think traders, investors, or anyone interested in markets should be aware of at this moment. That's what we do on this show. And by the way, this show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures options, and cryptocurrencies markets. One thing I always like to say about TradeStation as a user of TradingView myself and someone who has been following markets for 10 plus years, I think that the capability to connect your TradeStation account to the TradingView platform and research markets with a brokerage and a platform like TradingView at the same time is pretty awesome. And I think what's also cool is we have David Russell here, and he is the man running the TradeStation account on TradingView. So if you've ever seen an idea from TradeStation, whether it's in editor's picks or whether it's an idea you see on a symbol page, you're now are meeting, once again, the man who runs that account. So great to have you back, David, and thank you to everyone for listening to our intro. Let's get this show rocking and rolling.
Thanks, Steph. It's great to be back with you.
Excellent. And I think our last chat, for those listening, after you watch this, I recommend you go watch the last chat because I think you'll put a lot of things together about what's moved in markets since we last spoke and all the important things that we covered. For example, the chart that David has open right now, TNX, the 10-year Treasury note yield, which, holy cow, bunga, is still breaking out. I mean, I didn't expect that.
Well, there was a lot of expectation. Being a stock guy, you always want to be an optimist and you want to believe things are going well. And there's a part of me that was hoping and optimistic that that the interest rates were going to kind of ease down. And it doesn't pan out. So, part of being a trader, though, the most important thing is living in reality. And, when the chart doesn't do what you want, you have to stick with it. And at the end of the day here, this is, yields are moving higher and it's not a great thing for risk assets overall. But I think right here, it's interesting to see that the chart had kind of called it. This is a monthly chart of 10-year Treasury yields. And I think a lot of people have to realize is that basically maybe the longest and greatest bull market of all time has been what we've seen in the U.S. Treasury debt since the early 80s. And if we look at a long-term view here that really started like in 1985, this is back when Volcker was running the Fed early in the Reagan years. This has been a steady decline really until about 18 months ago. And we broke through it and we came down and we tested some old highs. And now at this point, we're at a spot where this trend that has defined the lives of probably most people watching now, whether you know it or not. It caused the housing bubble. It caused a lot of other things in financial markets. We're in a new kind of era now for the financial markets, and this chart tells us that. So the last time we were on, it was lower than this, and it's just extended to the upside now in terms of yields moving higher. And I just say what stands out to me here is I look at this, I don't really see much to stop this until it goes to about 5.25, which is about another 75 basis points to the upside. So I think that creates a difficult environment for equities in the near term.
Speaking of the historical importance of this chart, I could not agree more. I think we spoke about that briefly last time with the housing market. And I think that's an inverse relationship that, housing prices to interest rates. So if interest rates are going higher, then housing prices sort of have to reflect that and possibly dip a little bit lower. And so it's just so interesting to me that this chart goes so overlooked until it really matters, right? Think about the last 10 years. did we hear about this chart that often? I certainly didn't. It was sort of just a low rate environment, and now that has changed so quickly. It's still hard for me to fathom, really.
Yeah, and people take things like this for granted. And I think it's important to realize one of the most important things I think, in trading and in life in general is the thing is what is the assumption that you're working with that you're not aware of, but it's necessary to things that are happening. And in this case, a lot of the things we saw in the market, especially, in terms of the way the government spends money, assume that this would never end. And now that it is ending, it creates other sort of issues. And I would add that for me, this goes beyond housing. This is now a question of financials. It's a question of airlines. It's a question of a lot of companies that carry large debt loads, including the automakers. All these companies have high interest. They have interest expense, and when these rates move higher, it ultimately will squeeze their net income one way or another. And I think that's something that we are going to see, and we're starting to see. And I want to take a look at the Russell 2000 at some point in our conversation today because it is starting to show some of those pressures.
Okay, so we have to talk about that, and I'll tell you a little bit about the way I approach markets and the things I look for. Because when you mention the Russell 2000, my ears they pop up a little. But in terms of what you were saying about the interest expense, and we had chatted about value stocks too as well. Maybe you could just tell us a little bit more about what that means, and also what type of companies are there any companies that can thrive in that type of environment? So maybe just walk us more what you mean through that and where people should be looking in equity markets in a rising rate environment and what they should avoid.
Sure. Well, off the bat, there's not. The things that traditionally would do well would be more defensive things, and even those are not. The strength of them is not necessarily sustainable over very long term. One of the things I wanted to actually talk about later was going to be some of the defensive names that are starting to outperform now, like healthcare and consumer staples, which was not the case before. And it's giving us more a sense of a risk off sense in the market. But the real issue are going to be your companies. One of the things you can just do is if you look at a company's enterprise value versus its market cap, when the enterprise value is bigger than when the enterprise value is at least 50 to 100 times the market cap, what it means is the company has a lot of debt. And essentially that debt is on their balance sheet, but then they have to pay interest on that debt. And when interest rates go up overall, that will raise their interest expense. And that is like suddenly you have to pay more for jet fuel. Well, you have to pay more on interest expense. It's just a business expense. And it means that ultimately their net income will get squeezed. And a lot of the companies that did well, it's interesting if you look back in May, June timeframe, you saw like a stock like Carvana, which has a lot of debt. It was supposed to go bankrupt and then it didn't, and it like went up 1,000%. The reason is because people thought it was going to go bankrupt, and then interest rates came down and it had a relief rally. The airlines, the cruise ships, all these companies are loaded with debt. When interest rates were coming down and the expectation was that the Fed was near the end of hiking, those stocks did well, and they have done very poorly in the last month and a half. And the main reason is because of the fact that going forward, their interest expense will go higher, and that means their earnings will go lower.
I have to say, I love what you just were saying about enterprise value and market cap for all the listeners. And I want to go on a quick little rant about that, actually, because it's so fantastic. Exactly. If an enterprise value is above the company's market cap, it most likely means that it's carrying a lot of debt. And so you can actually do a very quick analysis in screeners or around markets, just comparing a company's market cap to its enterprise value. And here's another cool tip I found about that as well. Most of the time, except for very rare cases, when the enterprise value is less than the market cap, it means they have a lot of cash and they're subtracting the cash from the market cap. So you can quickly scan for things that have too much debt or lots of cash just by comparing market cap to enterprise value. So I think it's really cool you just brought that up, and that's going to be a valuable educational lesson for any new investors and traders who are watching this. I still don't know many people who know that. Of course, the experts know that, or people who've been in the industry for a while, but that's a very cool lesson for people to explore. But I do want to go down into some of those charts that you mentioned, or whatever chart you have next that sort of follows this this storyline of rising rates as they break out.
Well, that's first of all, I just want to add this line that I think is important for us to keep in mind here. This level from 06, 07, around 5.25. So I'll just add that one on the monthly here. So now I go to the S&P 500, and we did this one last time. We looked at a series of, now I switched to the daily chart. And so basically we saw that as the market rallied at different points this year, it held 50% retracements. And, what's interesting here when we get to early August is we lost that 50% retracement. We tried to hold, then again, we had this big rally in the second half of August. And then in early September, we held it. But now look, in the last 2 days, we failed it. So in my view here, if a stock rallies and then it pulls back and holds 50%, that can be just a really simple way to say it's in an uptrend. If it fails that, then it's a lot harder to believe you really have an uptrend. It's not always going to be true, but as a general rule of thumb, especially when you're trying to follow direction, if it holds at 50%, then continuation makes sense. If not, then hasta la vista. And in my view here, this failure to hold 50% here, and then again here, this is now changing the complexion of the market. Now, if we look at this on a weekly chart, we can see here that we actually have lower highs. I'm going to just hide my drawings, and I'm going to go down to weekly. And I have an indicator that came from, it's not built in the TradingView. Someone created it. I'm going to put in my inside-outside bars. What's interesting here is we had 2 consecutive inside weeks on the S&P 500. So price really squeezed together. And we also saw basically, and then we broke through the bottom of it. So to me, this is, when you see this squeezing with 2 consecutive inside weeks, that had not happened since in at least 5 years. I think that last happened in, I dug it up, but it happened before before COVID. So this was an unusual sort of volatility squeeze in the overall index.
Wow.
And what it means is, it means that when you break out, volatility is going to increase, and you're likely to get a pretty, it could be a pretty, decent move here in this case to the downside. And, that's what I mean. The charts tell you this. The thing to me also is I was looking at a level on the S&P 500 around 44.44. And the reason for me was that if you actually look at kind of an intraday, you can see that 44.44 right around here is when we broke in mid-August. We tried to hold it a few days, and when we broke through it, we went down pretty sharply, and then we came back and kind of tested it and failed back here on the 16th, and we tried to bounce around the same area. And yesterday, if you look on the kind of, like a 15-minute chart or something, pretty much around that same area, around 44.44, our inability to hold it right around here yesterday after the Fed meeting was really when the selling came in, and now it continues. So to me, there's a lot of things on this chart now that are telling us that we're in a different sort of environment. I also want to point out that this was when we had that really strong GDP report, the bearish outside candle on July 27th. And this was the high. And, you can see that candle has become resistant since. You can see we came down, and the bottom of that candle was resistant several times since. And it was also resistance here on September 1st, with then the lower high. And these are on the weekly. If you look, these are weekly highs. So to me, all these things now are in a spot where, it simply is no longer giving us a sense of an uptrend. The last thing I want to show is on this chart is to add MACD, because the MACD at this point, wait a second, I added the wrong indicator.
I have to say, I'll let you get, yep.
I said MACD is now kind of giving us a pretty clear sort of negative reading. So those are the last thing I want to mention here is that there's not a lot here, in my view, to, it makes sense to be expecting at this point this low kind of from late June, mid-August. And then the other thing is, if we really scroll back, it also matches this high from last August of 22. So at this point, I think, if there's any spot where we really have to be aware of, it's that. And then the question is, will we even hold that? I'm not so sure.
Wow. Yeah. Keep this chart open, actually. And I love that view, actually, that long-term view you just had, because I have some comments. And the first comment I have to say is, I always like how you zoom out to look for those levels of support that are a little more historical. That is definitely interesting. So right at that high from, it looks like 2022, almost a year ago, maybe there
August, last
August.
summer.
Wow, last
Yeah.
summer. Maybe we might see some support of some sort, and that's probably what. Oh yeah, wow, look at that. So, and it was even sort of a double bottom lining up there too. But I have to ask, I don't know. You know, the Fed reaction yesterday was so shocking to me because they held rates. And so for a second, I saw the headline that, you know, they're not raising rates any further. And I thought, okay, here we go. They see maybe that things are slowing down, risk might come back on. People can maybe get more, you know, a future look into how they're going to service their debt a little better if they have any. But I guess, sure enough, it turns out that they did all say, I guess, you know, majority of the members said, let's hike one more time this year. And that seems to be causing this sort of minor sell-off here. But it's very interesting because
Well, like I said, they also removed two cuts from next year.
Oh, two cuts or two hikes?
So for next year, they raised where they saw rates. Next year, they had been anticipating cuts, and they removed one or two of them.
Wow.
So what they did was they scaled out the likelihood of lowering. That was, in my view, the big thing. That really, and where there was coming of an expectation the Fed was going to be a little bit easier and say, you know what, maybe we'll tolerate 3% inflation a little longer. We'll let things go back to normal. And then it seemed there was an expectation they were moving in that direction. And then that basically got eliminated yesterday with the hawkish dot plot.
Wow, so that's such a key detail for you to bring up that I had actually missed. I was looking at just the aspect of, you know, them saying that they might hike again. I didn't realize they also went far out into the future and reduced the chances of them even cutting a year or more from now. So that's really interesting news. And I would add too, on that weekly chart you had open, I just want to point out one more thing that I think is interesting and worth respecting. Is on your weekly chart, you did have that downtrend going across the S&P 500. And yeah, that's it. Exactly. Those lower weekly highs. That to me looks like, myself as an investor, both long-term, maybe some short-term trades, you know, if there is any type of retrace, if there is a bounce, I'm going to be extending that line you have drawn, thinking, I don't know if you're just going to have to show a lot of power to break back above that. But nonetheless, very nice analysis of the S&P 500 after the Fed. And that's definitely what everyone is talking about right now as well.
I'll also add that we've now gone. One thing I love about TradingView is you can just do this and go to a monthly chart really quick. And then you can go here to the time frame. And I do this a lot. I'll go to like date range and you look here and you can see that we've now gone 20 months without a high. Wow. And then you can just go and compare that to other moments historically, and you can basically see that didn't happen back in the kind of period of 15 and 16. There was a period of consolidation for about 18 months, but we didn't go that long without a high. We didn't go that long without a high after COVID. If you look at it, if you look back, even coming out of the financial crisis, we never really went that long without hitting a new 52-week high. So in my view, this also is something that tells us that from a longer term view, it's a little bit, now things are a little bit less clearly bullish.
That historical perspective is fantastic. And I would say that that's why it kind of feels like a stealth bear market, even though it doesn't feel panicky or crashy or like 2008 or 2009 or the end of the dot-com bubble. That stat you just presented of no new highs, you said 20 months, is that right?
Yeah.
Wow, so no new highs for 20 months. What is that called? I mean, in your mind, how do you, do you think we're in a bear market because of a stat like that?
I'm now starting, in the last couple of weeks, I've started to think that we have the risk of entering something that looks like the 70s. And the reason I say that is because of the fact that at that time, also in the early 70s, you know, there was a point when it was kind of a false breakout, and then in 72, and then it came down. And I mean, it's not exactly the same, but what you really see is you see that the process of making consistently higher highs and higher lows over a period of months and months and quarters ended. And, you know, to me, I think there is some risk of that. Now, I will say that in many cases, this is, you know, caused by the fact that we have the Fed doing what they're doing. And you also have a lot of of this fiscal stimulus, and it's pushing up Treasury yields. So to me, it's not as as really lasting. There's a lot of things now, I think, fundamentally that are a lot more positive with the market than they were in the 70s. But to me, I think now the period of the likelihood of expecting this to last, for a longer period of time is a lot more probable, especially with that, like I said, with that extra, 75 of potential basis points of upside on the 10-year. At this point, I think it's hard to see any near-term push to the upside, which means it's not going to be just 20 months. It could be many more months beyond that. And then we're looking at going years without a new high. And then you have to ask, are we really in an uptrend when that's the case?
Fascinating. And I don't actually, now that we speak about that, I don't know many people who are discussing that fact and what it really does mean in terms of no new highs in the S&P 500 for 20 plus months. You think of all the indexers, even people who just hold some S&P 500 long, or it's a portfolio allocation of sorts. That is really a remarkable stat, and I think that's probably going to have to be. Wish I had the title of this live stream along those lines. No new highs for 20 months. But nonetheless, I don't want to keep us too focused on the S&P 500. I know you have a whole, set of charts for us, so I'll let you show us what's next on the list.
So we've been talking about the VIX and the 15 level on the VIX because it went back. Here's a daily chart of the VIX from. Actually, I'm sorry. This was the low. All right, so it was in October of 20. Yes.
Really quick, is that green candle on the VIX today's candle?
Yes.
Wow. So we have ourselves quite the day and week already. Okay, I'll let you go. I just had to, I could see that candle on the chart there that you're showing, and wow. Okay, got it.
So if you look at this level here at 15 even was actually a low from sometime in October of 21 when, we were still in this kind of big melt to the upside. We never really closed under 15. And then if you look in the last couple of months, we tried to close under 15 several times, and now we're back above it. So from my view, it's just interesting to see here that we're really in a spot here where it's hard to really, it looks at this point like the VIX is not willing to go any lower. And I think that's also something that we have to be aware of, is that we have this potential here of the VIX coming off the lows and people starting to buy puts aggressively. And then that becomes something of a self-fulfilling prophecy of what it will do to price on the S&P. So just the fact that the VIX has not been able to break this and we're coming off that low, going into the end of September, the end of our first negative quarter in several quarters, another red month. And then also, I think, you got to bear in mind that there's going to be more Fed speakers again. I don't have the calendar that ahead of me, but then in early September, the first Friday of October, I'm sorry, on the 6th, we're going to have the jobs report. And, today's initial jobless claims were stunningly low, the lowest, I think, since January. So, I mean, all those things right now, the hawkishness that we felt after Jerome Powell yesterday, in many ways, it's not done yet, I think, because we have those claims and then we have the non-farm payrolls about 2 weeks out. So those two things together, I think, mean that in the near term, we continue to have a pretty negative environment.
There's so much to unpack there. And I don't want to go too macro, but we have to, because that is such an interesting stat from earlier today, the jobless claims stat, which is obviously the lower it goes, the more people have jobs and are keeping in those jobs and staying in those jobs. Thus, you can assume that people are getting paid, they're doing well, there's growth, the economy's moving well. So if that's the case, then exactly, it's very hard for the Fed to not keep raising rates to some degree, because things are clearly going well and there's still a little bit of inflation. So why should they not raise rates? So I just wanted to make that comment because that is very, very interesting. And I also want to, let's talk about this first, because I have a question for you about the calendar coming up in the future.
Yeah, well, so this is the jobless claims on the St. Louis Fed website. You can see here 201 is the lowest since here in January 28th. So that was just the one to show that stat.
No, that's great context on that. And I want to actually talk to you quick about calendars, because as you know, a lot of new traders and investors will tune into this show, or they might be on their first year or second year. I always like how you look ahead to certain events. How closely do you watch those events? Like, I know a Fed chair or an important Fed member speaking in 2 weeks. I'm going to mark that on my calendar. Maybe you could just provide some insight into that style of research.
Well, I think you have to think of what is the thing the market is obsessed with. There was a time when the Fed didn't matter, like 5, 6 years ago, when they were just printing money, and then the Fed was kind of unimportant. But now the Fed does matter. There's other times when people are worried about OPEC, and then people are worried about, they'll pay attention to those. So I think it's a question of what is the thing right now we're worried about or hopeful about. And I think right now it's obviously strong economic data. Good news is bad news, for the market. So I think that we need to be aware what those items are going to be. And we want things that are forward, the most recent data. So like on the 28th of September, we have final revision of second quarter GDP. It's basically, it comes out 3 months after the quarter ends. It's completely irrelevant. Just because it's GDP doesn't mean it's important because it's old. It covers the quarter ending in June. So no one's going to care about that. You're going to have something that can give a sense of the future. And, so the way to think about it is the data coming out on October 6th is September data. So you should always think of what is the period that the data is covering. So the first data we get for any month, I'm pretty sure, are going to be the, you get the ADP data, but then, for the preceding month, and then you get the employment situation with the unemployment. So that's what I'm focused on. And then I don't have the date of it yet, but we're going to have minutes from the last Fed meeting. And that is something that will probably be a big deal as well. So that's going to be something at some point in mid-October, I think. I don't know. I don't have it in front of me right now, but that's going to be another thing to be pulling on the market. And you got to be watching for times when Jerome Powell might be popping up and speaking.
Because J Powell can pop up at any moment. And if you're not watching that calendar, and if, like you said, that is the narrative that the Fed cares about, and you don't know he's popping up at a meeting and says something, it does feel like that, where a single sentence from a Fed member at one of these meetings or conferences or events could move markets, and not just equity markets. It seems like all markets. So
the other thing I'll just add really quickly is the market can paralyze until it's over. So the thing is, you'll see the market might just sit and do nothing, and then he says nothing, and then it rallies after, and it's because everyone was waiting. So just knowing it's there can also help you know what's going on.
Fantastic, actually, for preparation. I've seen that often, where exactly the market is paralyzed. It doesn't know where to go as the event's approaching. And sometimes it feels kind of dull as well. And then the minutes before that event happens, there's a big whiplash. And then the minutes after, there's a big whiplash. But you're just sort of sitting sideways until that event. So that is a very cool anecdote to share. You have the Russell 2000 open. Small caps have been getting crushed as far as I can tell. But tell us about this chart. It's not as bad as I thought, actually.
Well, I'll point out a few things for you. Remember, the S&P went over its high from last August. The Russell did not. This was last summer here, this point. All right. So if you look at it, the Russell never broke out above its last summer high. This is a weekly chart. This is August of 22 right here. So basically, we never broke out. The S&P went up above that level. This remained below. That is a sign of relative weakness. So from my view here, there was a research report that came out of SocGen, Societe Generale, that basically kind of identified how smaller companies have more risk of higher interest expense, and they're in the Russell. So from my view here, it's kind of interesting to see that, we are still range bound. And one of my things is, as a trader, you have to recognize when you're in a range. We all want trends. We want something to just go, but it's really annoying when it doesn't happen. But when you're in a range, you have to just turn your head in that direction and say, we're in a range, we're going to hit the range extremes, and I'm not going to do, I'm going to respect the range and not expect a trend. And in this case, we haven't broken out. There's an overall negativity coming in the market, and I think there could be something of a sort of, of a gravitational pull toward these levels from kind of last summer. I mean, of June of, this really goes back to June of 22, and then October, September of last year. To me right now in the Russell, this looks like something that if you give it a few weeks, that's probably where, there could be a probability of that happening.
I sigh a lot there because I may or may not trade some small caps, and I've seen some of the very difficult trading action there. And I want to say on the report you mentioned, it does make a lot of sense to me because companies in the small cap space that have tons of debt, and let's say they, even if they took that debt out when rates were low, but they haven't been able to make enough profit to pay it off, and they have to service that debt or pay it all back, let's say in a year. But if they don't have the money to pay it back in a year, they're going to have to raise money again. But we're talking at now like potentially 10%, right, which is really just going to hurt their business. So yes, I just wanted to say that because that is a very, I don't want to say dangerous, but very big risk to small caps. And yeah, the Russell 2000 is the way to measure small caps as well. So that is an interesting chart. In that bottom of the range, I actually should mark down. That bottom of the range looks like it wants to get tested. Oh, and it corresponds perfectly with the pre-COVID highs. Is that what you were showing?
Yeah, it does. Yeah. Not exactly, but pretty close. So I think, there's something to, this false breakout. And, one of the things I find is that the long-term charts like this can tell you where you're going to get the explosive moves when they start happening. So from my perspective here, this is something that looks pretty challenged, and it looks like it could lead to the downside, and the most kind of extreme bearishness could happen in the Russell. But it also means that when we finally get to that point when the Fed is done, that could be the spot where you get the most return to the upside. And I think that's another way to think about it. So I think that this is just something I just want to point this out, because the other one, this is not a small cap, but in some ways it's similar to a small cap, and that's Citi. We had talked about this last time, this kind of breakdown in Citi. We had a little bit of a bounce on it here, but, to me, these are, there's a bank that has a big global exposure, not a terrifically, performing stock in the long run here. And it's interesting to see we had this nice kind of rebound, but this could give that little opportunity for the momentum people who wanted to hit the downside in it to come back in. So to me, this was one that I think is interesting. It kind of, couldn't break to the downside right away, but now kind of had that retracement. And now you could see, I think, potentially a push to new lows in Citi. Also, Regions Financial is just one that it's like, it's one of these regional banks, but these guys have really taken a beating. Another one is TFC, Truist. All these here, to me, when you look at them, these sort of failed attempts at getting back into that gap, they couldn't, and just the squeezing to the downside here. So, all these to me here, with interest rates moving higher, these also have a kind of downward pressure in them that I think we could see. So I think right now these regional banks, they had kind of stabilized, and it looked like they were trying to be okay. But you look at the charts here, there could be some more downward momentum in them.
So to provide some context on, I think, two sort of things that are happening, whether it's looking for a opportunity or to be aware of or to think about sort of next step in markets, I kind of take the Citi chart as an oh my gosh moment of, wow, big banks are even breaking down now. And that seems like something to have on someone's radar, that Citi is breaking down. And what type of lows are these so if it breaks that bottom of the trend that you drew, would that bring it back to its COVID lows? Wow, it really would. Wow.
Yeah, pretty much it's a COVID lows. And it's such a big bank. I mean, you got to worry if a company like Citi really took a beating, what would that do? So I think that there's a risk, I think, here that is, on my view, is something that I'm not sure how bad it will get, but I think we have to be aware of the fact that, Citi remains in a downtrend. It's one of the biggest banks in the country, in the world, probably. And, if this thing really takes, a lot of selling pressure, that could have some significant ripple effects. And I think that that's something that we should at least, be aware of.
And then to the regional banks, I've seen some people publish research. They're just individual traders or investors. I don't know the exact research. I've only looked it over briefly, so I'm not going to go too in depth. But I've seen, for example, I think it was Truist that you were showing. Yeah. I've seen some research about Truist sort of being in a position similar to some of the other regional banks, where maybe it doesn't really have the greatest balance sheet to cover certain aspects. I don't have to do research into it, but I only say that because it's very interesting for this chart to be shown because I had that memory of reading some of this research. And yeah, that looks like, the market thinks something might be up as well with this particular stock.
They say that correlation is not causation, but in trading, when you see correlation, you shouldn't ignore it. And there's a clear correlation, I think, between interest rates, bond yields moving higher, and regionals moving lower. And like I said, when you see that breakout of the 10-year, it just creates a risk really in all this entire bucket of regional banks.
And if I understand correctly, and I don't want to get too complex, but for those who watch this and tune into this, there's sort of an element of a savings bond at a bank, say, is giving 0.1% interest. But if you take your money out of the savings account, so you move it out of the bank account and put it into a treasury, you get, I think we saw the 10-year at 4.5% or more. So that's sort of like a reason for money to leave banks, which is obviously not great for their business model. So,
and if you go to 1 or 2-year treasuries, you're getting more than that. So, I mean, if you just have your normal savings and it's money you're not expecting to spend, for the next 3 to 4 months, you can buy a treasury security of some kind that's yielding over 5%. And so people with large savings who are doing large, cash management and stuff, it really argues against keeping your money in a bank account at all.
Fascinating conversation, fascinating charts. We could go so much deeper into that, but we're sort of, hey, we just gave a lot of our viewers something to really chew on and research, which I think is exactly the purpose of our chat. So very interesting with potentially really big ramifications for everything, every asset you can imagine. So crude oil, holy cow, I cannot get over crude's recent run. I was not expecting this.
Well, for me, and we've been kind of watching it with some of the stuff we do at TradeStation, based on the fundamentals, and the extremely tight supply. But I'm not bearish on oil, but from my perspective, I think that there's a spot here where, excuse me, it's a lot harder to have the same kind of confidence in it. But the Fed being this hawkish, we've seen this before when the Fed is hawkish and people look at the cyclical stuff. And when you look at, there are some patterns here to me that say it's time to maybe be not, complacent if you're long energy. And because if there is a level that goes back here from this level here last fall in October, November, we didn't reach it, but we had a shooting star below it. And we went to an overbought condition on RSI. And then we also had some bearish divergence. So from my perspective here, this could be something where, we just look for energy to consolidate here. Maybe have oil pull back toward 85 on this chart of crude, which is now around 90. So I want to just point that out that this might give people an opportunity to if they're looking to have a couple of weeks, a week or two, maybe a pullback in energy, or at least to be careful of being complacent about if you've had some longs in it, to maybe not just be complacent about it.
Yes, very.
So next, if you don't mind, I did want to show the euro, because we looked at this before, and we had, wait a second. All right, so we had, wait a second. Euro USD. All right, we had the month, I think we did before the weekly chart of this. And what's interesting to me is we had talked about it going down. When we talked before, it was up above. It was kind of in the middle of the channel a little bit more, and we were talking about the risk of it going down and kind of, hitting the bottom of this rising channel. But now that we've broken through it, to me, this is something where if we look at this is now potentially like a bearish flag. If you look at the move in the euro, between January of 21 and basically last October, we basically retraced about half of that, and we're not able to hold it. So from my perspective here, from a longer term view, there could be, some more downside risk of the euro back under $1. So I think that this is something that's on my view as well. And, as the euro kind of weakens, there's a correlation between that and interest rates moving higher. So that also will have an impact on certain companies that have overseas business. Generally, a strong dollar in a weak euro is going to be bad for risk. So I think this is another thing. I mean, it's gone down like multiple weeks consecutively. And, it might sit here for a little bit, but this is maybe one to think about with that. What I say, payrolls on the 6th of September, Fed minutes. Maybe it sits here until you have one of those catalysts. But that's another thing I think when you look at here, we have something that's looking like we broke a bearish flag in the euro.
So two super important charts for the global landscape of investing or trading. Oil, which you were just showing, and now the EURUSD, which indeed that breakdown. So would you consider, though, because the euro broke that sort of uptrend support it had, I guess now the trend is over, right? Because, oh, you're right. So that trend is now a bear flag breakdown potentially. That entire move is just a bear flag within a bigger move. Oops, I think I had a fire alarm go off for a second. Okay, take us to the next one so I can go on mute so you don't have to listen to this beep.
All right. So, excuse me, but Palantir. Now, this was one here that to me was another bear flag that to me, this is one we want to actually be thinking now about. There's a few ways to do it. You can do it as a parallel channel, but you look at a stock like this now where, you've got PLTR. It's a big AI name. But what's really interesting to me here is that first, let's look at it without the markups. You can see that we went under the 50-day, could not get above it. And then basically we put our markups back on. You can see we had this level here from July 21st with support, and then it became resistance. We were unable to get above. And then we had this series of this very slightly higher lows that we then broke. So this is now a bear flag. So from my perspective here, and look at something like Palantir, this is something that now has some space. It's trying to hold this level at 1375 from back here on October 18th, August 18th. But I think this is also one here that, could be a candidate for, some more momentum to the downside. Another one I want to mention.
Yeah.
Go ahead.
No, David, keep going, actually. I am
Alibaba.
enjoying this. Yeah.
Let's take a look at Alibaba. Let's do this on a weekly as well. For me, China has been, when you consider the stronger dollar and a lot of the macro things happening in China here, I mean, this is, to me, again, we have, at this point, you can see it's trying to hold this level around 70, 79. And then you have essentially here, potential here of this having some continuation to the downside. And I think we all know the problems that China faces. From my perspective, there's a risk of them actually kind of getting worse, because the thing is that they've tried to juice their economy some, to give it the adrenaline shot with some stimulus. But I think ultimately they're in a spot where, they still have a lot of problems, and there doesn't seem to be a clear, immediate sort of solution to them. And a name like Alibaba, when you look at this kind of price action, to me on the weekly here, looks like we could see some kind of continuation to the downside.
And if it really quick, if it breaks those lows, right? Okay, so it still has. Is it below its IPO price even? Is it?
I don't know.
Let's see. Oh wow,
it's back where it was in 14.
Remarkable. Yes, that really says a lot about emerging markets too, in my opinion, about what the market thinks of them, because Alibaba sometimes could be considered a barometer for all of China. So this is a really important chart. Back to its IPO prices. Holy cow, it's underperforming the S&P 500, the NASDAQ 100, almost every other tech stock. Thank you for pointing this out. That is well worth watching as well. What was the next symbol you're going to take us to?
Well, United Healthcare. So going from something kind of exciting to something that most people probably wouldn't want to be caught dead trading, because it's such a boring stock. But big health insurance stock. It had this golden cross. It's interesting to kind of see that on a bearish day, this stock is rallying. So we've seen a little bit of strength in some of these things like health insurers and stuff. Centene's another health insurer. These are names that when you look at them, this is a major industry, and this is sort of place where people might actually be starting to look for some strength when everything else is bad. The other thing about these companies is that a lot of their business is going to be exposed to the hiring cycle. So the thing is, as long as people have jobs and stuff, their business is relatively stable. They're safe havens, and they're kind of just their own little universe of stocks. And this strength right now, I think, we talked about how health stocks were relatively undervalued. If you look long term, we did this thing before. I think we look at like XLV divided by the S&P, And we had talked about how the health industry was long term, sort of, at a low point against the overall S&P. And, I think it's interesting to kind of realize that right now. It's interesting also the way that it rallied so big last year at the end when we had a bear market. So I think right now, if we're in a period of negativity, you could see some relative outperformance in some of these names, in some of the health insurance names, but just the overall health sector.
I want to say on that note something a little different, but it's related to all of this. It's that you had the chart open of CNC, and I always find those charts interesting because I've actually never heard of CNC. But to see it potentially as a play is a reminder to me that no matter what type of market you're in, let's say it's bearish or bullish, often if you do your research enough and do this type of top-down approach, right, you find this sector that is showing strength, then you dive into that sector, you might find some new companies or new opportunities. And this CNC chart is just interesting to me because I'm not aware of it, but I can see that relative to the market, which I believe is still getting hammered at this point in time, it's green. It's up 2%. So that is very interesting. And the green line there, what type of moving average is that? It's
that's a 200-day simple.
So this is a huge day for this stock because it hasn't been right. If it can close above its 200-day, that has my attention. That is very interesting.
It's also interesting if you look at this. It kind of had this false breakdown. It went to this new low and couldn't hold. So there's some signs here of this sort of area bottoming. And, I'll say one of the trading ideas that we did recently was this company called Vertex Pharmaceuticals. And this is also one that was pretty interesting, VRTX. I haven't looked at it today, but this is also a name that had kind of closed at a high, had some follow through, and it's green on a bearish day. So, I think it's interesting here to take a look. The one other I'll mention, though, is the Eli Lilly. I mean, it had run so hard that it's still pulling back pretty sharply. But Eli Lilly has really emerged as a real outperformer this year. So I think this is another name here with this pullback in this being a healthcare stock that, this might have something where people looking for some momentum might get an opportunity, in the next week or two.
Eli Lilly, agreed. That is a run for a company of its size with an over $100 billion market cap. So that gives context to that uptrend. Let me quickly, before I have to go on mute again, ask you one more question, which is, you posted a chart called "Are Chips Losing Their Edge to Software Stocks?" Could you walk us through that idea? I think that's a great one.
It was basically just looking at the relative strength of the IGV versus the SMH. And we basically had shown over longer term that software versus semiconductors were historically, cheap at levels going really back to like the middle of, before 2010. So, my view, one of the things I looked at with stocks against the S&P 500, stocks divided by SPX, is that the software industry, the semiconductors had hit really levels that were historically epic in terms of all the way back to 2000. And so from my perspective here, when you look at semiconductors, they had just reached an extreme amount of overbought condition. And the other thing about them is they have a lot of international exposure, a lot of Chinese exposure. The software companies are far more domestic. So my view is that, when you look at something like the software names, a lot of them have been performing better in the short term. We had done, a chart idea on something like Viva, which is a software name. You and I were talking about Splunk, which kind of had this Perkins acquisition today, SPLK. But a lot of these stocks had this kind of shorter term momentum that was looking a lot stronger. Another one was OKTA. They had some really, the short term momentum in them was a lot stronger than you saw the semiconductors. A lot of the software stocks, like the IGV, was above its 50-day moving average when I did the idea, and the semiconductors were below it. Now, they're both below it, but the semiconductors have underperformed in that time period. So I think you can then look at and see the actual distribution of things, how they're performing relative to other areas. And, there's really, within technology, you have software, you have semiconductors, and then you have devices like Apple. Those are the three big buckets in tech. And, chips had led, and now we're seeing we're just seeing that change. So for me, it's often a question of the relative strength.
I want to add to this chart of these semiconductors and why I think it's important for even crypto AI, anything with that sort of an emerging tech like that, they ultimately are users of semiconductors. They need semiconductors to really be processing information or transmitting information at a very rapid speed. So I just bring that up because I want to make sure if you are someone who's interested in crypto and you happen to stumble across this live stream, you can see how this type of research or this type of analysis can even applies to you to some degree, because semiconductors are sort of the backbone of crypto in a lot of ways. So this breakdown is something to take note of. It's something that you may also want to watch, maybe create a similar looking chart. So that is very notable. And, the trend seemed to have ended faster than I thought. I thought the AI trend was only going to empower semiconductors, but wow, that lasted a solid, feels like 3 months, and now it's all over.
Last thing I'll just say is, something of a head and shoulders here when you look at the SMH, this lower high, this kind of failed breakout, rounded top. To me, this is something we might look back on in a couple of years and be like, and just kind of realize that semiconductors are, might be entering a longer period of stagnation and downside.
I think, David, that's a perfect way to end it, right at 4 o'clock. And I believe that for all of our viewers, they're going to walk away with some really good information for next steps until our next chat. And please remember that if you were watching this live stream, to the 200 plus people who popped on in, remember you can ask us questions. There's the TradingView account on TradingView. There's also the TradeStation account on TradingView that David runs. You can boost his ideas. You can comment on them. The account is active, posting ideas, several ideas per day, I want to say. And so, don't be shy. You can write comments and get some really great opinions similar to this conversation. So, David, once again, I want to thank you for joining the TradingView show. And we cannot wait to have you back on for the next one, which I think we might do in October, if that works out for everyone. So great having you on. And I guess before we head off, is there any last word that you want to leave our viewers with?
Well, we closed below the August low there, so we talked about it, and it did happen.
In semiconductors or S&P 500?
No, the S&P. We closed under that August low.
Wow.
So it's an outside month as well, bearish outside month. See you next time, Stefan. Have a good one.
David, thank you so much, and we will see you later.
Take care. Thank you.